Amazon warehouse workers just got one step closer to unionizing. The e-commerce giant and a group of workers in Alabama agreed to crucial details on how many and which types of employees could vote to join a union. No official word yet on when a formal vote might happen, probably next year. John Fort, Amazon has been pretty staunch in opposing unionization. Whole Foods, one of their subsidiaries, also the same. They've fought back against unions. What's changed, and why is this battle taking place in Bessemer, Alabama?
Well, I don't know exactly why it's taking place in Alabama, Tyler, but this is important because of the trend, the movement that we've seen throughout 2020 of big companies, particularly tech companies, getting stronger, more relied upon, and arguably frontline workers being more at risk and really suffering in this kind of pandemic-fueled recession. I mean, Amazon's workers, the same ones who are allowing this e-commerce process to work, are those very same frontline workers who have been disadvantaged during this time. So it's important from a labor standpoint and from a cultures of business standpoint there. Also interesting because Amazon is pushing for this union vote to happen in person instead of by mail-in ballot. Think about that. Like, part of the whole reason why Amazon is so popular this year is because people want to do things distanced and by mail. The union wants that same thing for this vote, and Amazon does not.
A great irony there. Dom, the stock has been sort of basically flat since the late summer. What would unionization mean if it sticks, not just in Alabama, but elsewhere?
If you look at the assumptions for what drives valuations, not that Amazon is the typical kind of valuation case for academia or anywhere else, but it comes down to corporate profits, corporate revenues, the kind of the financials behind it. If you start to value a company differently, it will be oftentimes because the profile has changed for the company. Whether unionization does add to more costs, some would argue it adds to more inefficiencies within the workplace and everything else, while it does then boost the actual wages of those people who are working there, that might start to change some of the investor kind of appetite for some of these types of stocks. Now, that's not to say that Amazon goes away. It just means that people say, hey, you know what, if wage costs are going to be this and they're projected to be this over time, this could change the way that we value the company over that time span as well. And by the way, if you take a look at the Amazon kind of profile right now, there's been a case that they've been making to workers right now that there are benefits and drawbacks to being part of a union, something I'm sure that's going to play out in a huge debate when that kind of vote starts to take place next year.
This has certainly been the case in the specific case of Whole Foods, where they made the case very strongly that there were advantages and disadvantages. I'd take the over on the idea that Amazon's not going away. I don't think it's going away anytime soon. While we're on the topic of warehouses, the e-commerce boom has demand for storage facilities going through the roof, and those stocks are heading higher. Public Storage, CubeSmart, Life Storage, all up nearly 10% or more in the past year, and those gains have caught the eyes of private equity firms. Leslie, you have been following this for us. It's not just storage facilities, but it's also distribution facilities. And who are the big players in PE who are moving in here?
Every aspect of the supply chain, and private equity has had its eye on this space for a while, and especially so this year. The stat that really caught my eye, Tyler, is this idea that for every $1 billion in incremental e-commerce sales or revenue, they need an additional $1.25 million square feet of warehouse space to support that additional e-commerce sales growth. So for that, the biggest player in the private equity world that's been looking at this has been Blackstone. They have about $90 billion in assets under management in these types of facilities. $90 billion. And the big benefit for private equity firms that have gotten into this space in a big way is that as you see demand rising, and especially for those types of warehouses in areas close to urban areas where people are wanting their deliveries quicker, it's important to be nearer to the source of that purchasing power. Those warehouses have gone up tremendously in valuations, and it's also allowing the owners of these warehouses to charge more in rent. So it's been a big return on investment this year for a lot of these firms. The question, though, Tyler, is whether that continues in the future if this e-commerce growth that we've seen is sticky enough to allow them to continue capitalizing on these investments.
Yeah, these are large. In many cases, correct me if I'm wrong here, Leslie, these companies, whether it's Blackstone or KKR, are actually buying warehouses or storage facilities from existing companies. They're not building them. They're not absorbing whole companies. They're buying from Iron Mountain or whomever.
That's right. They're buying them from other companies. Typically, that's the norm of that investment there. And then they will have an operator actually manage the facility. And then that is oftentimes even leased out to another company. So there is kind of a chain of command there. But certainly private equity has been viewing this as an attractive investment over the last few years.
Shepard Smith here. Thanks for watching CNBC on YouTube.